Good afternoon, everyone. Thank you so much to ST Property and SPH for inviting me over to come here to Singapore to talk about our markets in the Philippines. It has been very active during the past few years, mostly because of local demand, but also because of international investor demand that are coming in. So I'll talk first about the Philippine economy, just in case you're not that familiar with how our economy has been doing. Uh, and of course, that would substantiate the growth in real estate that we've been seeing. Okay, so the Philippines was mostly referred to as a sick man of Asia and has been on a path of recovery for the past few years. And we've only started recovering because of the entry of a very good president, which has been trying to stamp out corruption and also inequality in the Philippines. And it has been become more transparent, and that's why a lot of international investments have been coming in. So the economy also has become more stable because of numerous financial and monetary policies that have been imposed into the market. And because of this, we are now officially investment grade based on the top three rating agencies. We are triple B minus now. So we received the last upgrade from S&P, which graded us at triple B neutral. So because of this, there's a lot more trust in investing into the Philippines. And of course, the growth has been supported by a very big population. So we're now almost 100 million. Estimates now it's about 98 million Filipinos. A tenth of that is actually working abroad and supporting the economy, sending back remittances to support their families in the Philippines. And that, of course, has its impact on real estate, not just in residential, but also on retail. Okay. So just to show you how the economy has been doing, we just recently got the numbers for the third quarter. We're now down to about 5.3% as of the third quarter. So we have been affected by numerous natural calamities as well as the slowdown in government spending. So the economy has slowed down a bit, but overall we're about, on average, more than 6% for the past 4 years. Last year we ended up with 7.2% in growth, and we were second to China in the region. So we do hope that trend continues. And some economists and some financial pundits estimate that we will actually be the 16th largest economy by the 2050, and we're all hoping that will actually transpire. And it's really supported by the growing population, and it's becoming more highly educated. And of course, a certain percentage of that is working abroad, and we're hoping that some of the skills will be transferred back home to help prop up the economy. Okay, so as I mentioned, OFW, or the Overseas Filipino Worker remittances, have been supporting the economy. So about a tenth works abroad, and it actually accounts for about 9% of GDP. The money that they send back home is used to buy, the basic necessities, food, clothing, and of course shelter. For housing, they spend about 30% of that remittances to they invested in housing, so either through purchases, home purchases, as well as rentals. And now the OFWs are becoming more sophisticated. They're more becoming more investment savvy, and they're just driving that into purchases in housing as well as other investments. Another driver that you may have heard of is the BPO industry, or the business process outsourcing industry, mostly of which are call centers because of the high level of English proficiency that we have in the Philippines. This has become a major economic driver. So last year, at the end of 2013, this was employing about 900,000 full-time employees and generated about 15.5 billion US dollars. This will jump to about 48 billion US dollars by the end of 2020. So we do hope that that actually materializes. This, of course, because of the higher pace from the BPO industry, and they're employing the younger set, their disposable incomes are actually very high compared to the typical salaried workers, and that generates demand for housing as well as retail consumption. Okay, another driver would be falling interest rates. Mortgages are still higher compared to what you find here in Singapore. It averages about 6.2%. So, comparatively, it's not that high. But if you take a look at the trend line, it's fallen quite a bit compared to 12 years ago, which they were formerly in double-digit rates. But now, this allows more people to finally afford homes. Okay, and just to show the increase in the GDP per capita, or the income rate. So we've grown by about 9% since 2010. This was second to Vietnam, but higher compared to Indonesia and Thailand. So as you can imagine, incomes have been growing, so that increases the propensity to spend. And on a local level also, across the board in the Philippines, that it's grown by about 4.9% between 2009 and 2014. Now, one thing that we're counting on is what we call the demographic sweet spot, because a lot of our population is actually below the working age, and they will finally enter the workforce by 2015. So there will be a deluge of workers. So there will be more people that will be employed, and that will eventually have higher discretionary spending that will prop up the economy. So this is one of the reasons that a lot of economists point out that will actually drive the growth of the Philippines in the next few years. So about 30 million Filipinos are expected to join the labor force in the next 15 years. So this will drive our growth. And then because of the attractiveness of the Philippines during the past few years, foreign investments have been increasing. So on average, it has grown by about 12% annually since 2010. So we do hope that this will continue. It's still not as high compared to other economies such as Thailand and Malaysia, but it's increasing. Actually, for manufacturing, there's been a lot of Japanese investors that are coming in because of the increases in labor costs in China. So some of the manufacturing sites are moving back to the Philippines because the labor costs are now comparatively lower. So of course, this will generate more jobs in the Philippines. Now, go into the details of investing in Philippine real estate. So interesting slide comparing the different markets in the region. So we're actually highest in terms of the gross rental yields in ASEAN, as well as some other economies in Asia. So we're followed by Jakarta at 6.8%. So we're at 7.4. And then Tokyo's at 5.5. Singapore, based on our data, 3% gross rental yield. And then Hong Kong's only about 2.7. So as you can see here, the rental yields are very attractive. But of course, just a caveat, this does also reflect the risk in investing in the Philippines. So also, because of the cooling measures that are being done on the housing markets here in Singapore as well as in Hong Kong, there has been an influx of foreign investment in the Philippines, and they're drawn by that figure there, the attractiveness of the rental yields. If you take out the expenses on property taxes as well as other expenses related to renting out a property, you'll probably end up with a net rental yield of between 5 to 5.9%. So still quite attractive. And then comparatively in terms of the capital values, or how much the property costs on a per square meter basis. So these have been adjusted to Singapore dollars. We're the third highest among this list. So we're only more expensive compared to Jakarta, which is about 10% lower than us, lower than the Philippines. And Kuala Lumpur is about 17% or 18%. And it's about 1/5 the cost of the average price of property here in Singapore. And then going into the different CBDs, so Rockwell Center, which is located outside of Makati, is the most attractive in terms of yield. So later on, I'll talk a little bit more on these locations. But the usual investment areas would be Makati CBD, Rockwell, Fort Bonifacio, and Ortigas Center, as well as Eastwood. So these are usually the top CBDs. But I'll talk about some of the other hotspots later on. As of the third quarter of 2014, Rockwell presented the highest rental yields. So these are the most attractive ones, followed by Fort Bonifacio, which is an emerging area. And I would say that it would be this financial center of the 21st century in Manila. Okay, land values have recovered from their lowest point back in the Asian financial crisis in 1997. So they have declined quite a bit. It was affected also by some political upheavals in the early 2000s, and they've only recovered or surpassed the highs this year. So we're now on the way to recovery. However, as I'll show you in the next slide, if you adjust it for inflation, it's still only about 50% of the high. So I would say that there's still a lot of potential to go up as long as all of the economic recovery potential could be continued. Okay. Also, to highlight, Fort Bonifacio, it's only about 13% at discount in terms of their highs back in the 2000s. Okay, for our lease rates for Makati CBD, Rockwell, and Fort Bonifacio, annually the growth rate has been stable at 6.9%. So we haven't, if you just look at the statistics, we haven't had any sharp increases in lease rates that would indicate a bubble. We've never had any increases in the 20% range. So it has been always steadily growing. So as of the end of 2013, our estimates would be about 27 Singapore dollars per square meter in Rockwell, and then about 25 Singapore dollars in Makati and Fort Bonifacio. And the growth rates would be about 4 to 5% annually. For capital values, they've grown between 2003 and 2015. Our forecast for 2015, the growth rate is about 7.5%. So again, it's really nothing to be worried about, and it does not indicate any sort of bubble, no sharp increases. We did see double-digit increases back in 2013, but that has subsided quite a bit in 2014. So again, I would say that it's a stable market. It's just really driven by fundamentals. For vacancies, so these are the trends. As of September 2014, premium properties have a vacancy of about 5.15%, whereas grade A have a higher vacancy of about close to 6%, almost 6%. So if you take a look at the trend line, it's, none of these sectors have reached a 10% vacancy rate. So it's still an attractive prospect for investment. And then I'll talk a little bit about where to invest in real estate in the Philippines. So these are the hotspots that I would look into if you are considering investing in the Philippines. So Makati CBD is, I would say, on the top of the list. This has been the financial center of Metro Manila since the 1960s. This has been mostly developed by Ayala Land, which is the top developer in the Philippines. So they control this area. So if you've been to the Philippines, you've probably been to Ayala Center. So again, it's a financial hub of the Philippines. Outside of the CBD, you would find some infill developments being pursued by developers such as Rockwell Land. So Rockwell is actually quite attractive, especially with expats. This is their preferred address, Rockwell Center. And as if you remember, I showed the slide earlier, their rental rates are highest compared to Makati CBD and Fort Bonifacio. So I would also take a close look at any projects that are being sold there. And then also a newer township is being developed by Century Properties. It's called Century City, which is also outside of the Makati CBD. So they have some projects here that I will highlight. Okay, Garden Towers by Ayala Land is actually in Ayala Center. So it's a very convenient location. You just cross the street and you're already in the Ayala Center malls, so Glorieta and Greenbelt. They're currently selling at around 640,000 Singapore dollars on average, and they have very large unit sizes. So, just look at that. Yeah, about 132 square meters on average. So that's much larger compared to what you would usually see in Manila. Okay, Raffles, you're very familiar with this brand, so we now finally have a Raffles branded property in the Philippines. This is also in Ayala Center, in one of the most prime spots in the city. It was completed in 2012. So it's actually a development partnership between Kingdom Hotels and Ayala Land. So as you can expect, the quality is very high. They offer amenities such as 24-hour concierge, dedicated owner services team, personal butler service. So all of the things that you would expect in a Raffles property elsewhere in the world, you would find here. So in terms of pricing, for a one-bedroom unit, it would usually average at about 530,000 Singapore dollars. And then a three-bedroom would be about $2 million. So since this is completed, you won't have to wait. Like if you buy off-plan, you would usually wait for about 4 years for the property to be turned over to you. And that's the only time you could begin reaping the benefits of your property. Since this is already completed, you could lease it out right away, or usually you put it in the pool wherein it's rented out as a Raffles hotel. Okay, I was mentioning Rockwell Center earlier. This is their latest project, actually one of the last parcels of land in the area. It's called the Proscenium. It has 4 residential towers and it's an office building. And they do have a performing arts theater in the development. So they're calling it the greatest Rockwell project yet. It's developed by Carlos Ott. It's designed by Carlos Ott, the architect of the Burj Al Arab in Dubai. So he's a international renowned architect. And on average, they have very huge unit sizes. About 300 square meters is the largest one. On average, it's about 166 square meters. So very exclusive, also very nice property. It has a connection to the power plant mall, also in Rockwell Center. Okay, Century Spire, it's by Century Properties. Century Properties is actually one of the newer developers in the Philippines, but they've made a name for themselves because they've been churning out a lot of high quality developments, and they usually partner with big brands such as Armani. They partnered with Donald Trump, as well as they have a branded residence by Paris Hilton. But that is their strategy. This one actually will be fitted out by Armani Casa for the common areas. And also this is designed by Daniel Libeskind, so one of the world-renowned architects. The average price of this would be about 16 million pesos, or about 480,000 Singapore dollars. So yeah, it's one of the exclusive properties in the Philippines. Although comparatively, the cuts are smaller if you compare it to some of the Ayala projects or the Rockwell projects that I showed you earlier. It's about 50 square meters. Okay, another hot spot would be Fort Bonifacio. So this has been quite popular because it now presents an alternative to Makati. Makati CBD was designed back in the 60s, so it's not as efficient. This property started in the 1990s. It was a former military base, and it's designed quite well. It reflects, more a westernized approach to urban planning, and also, so you would find Bonifacio Global City in the center. This is controlled by Ayala Land, and then Mega World, which is one of the other bigger developers in the Philippines. They control Uptown Bonifacio and the McKinley Hill area. So the BGC is actually popular with a lot of office developers, especially those that are working in the BPO industry because of its location. So, if you are renting out a property here, I would say that you would have an easier time compared to other areas because of the demand from the office workers in the area. So some of the properties that are being developed here would include a Grand Hyatt, which is also quite attractive because of its international branding. And one other would be East Gallery Place by Ayala Land. It's now one of the most or more expensive. It's on the high end uh, projects in Fort Bonifacio, selling at around 717,000 Singapore dollars. One unit here sold at around 200 million pesos recently, which a lot of pundits are saying that it indicates that there's no bubble because some people are still buying units in this area, but it's really one huge unit of about 1,500 square meters. So it's a penthouse unit. Okay, for other interesting areas, I would say that if you're looking for areas with a lot of growth, the Manila Bay Reclamation Area would be one of those areas, primarily because values here are still at a discount compared to those found in Makati and in Fort Bonifacio. If you compare the land values, land here sells at about only 30% of what you would find in Makati. However, in terms of rental rates, it's about 70% of what you would find in Makati. So, there's a lot of opportunity here in terms of growth. So it would be strategic if you take a look at this area. Also, this area is where the casino district is now being built. So we have one casino that's existing. It's called Soler. The second one, the City of Dreams, will be opening its doors at the end of the year. And then there are two other casino developments. A Resorts World is also being put up in the area. So this will be a tourist spot in the future. Also, the Mall of Asia complex is found in the north, so this area. This is where the Mall of Asia is located. It's the 10th largest mall in the world. And surprisingly enough, when this was being built, a lot of people were saying that who's gonna go to such a big mall in the Philippines? But today, if you go there on a weekday in the morning, it's there are a lot of people that are coming there, shopping or having lunch or dinner there. So it's a really huge market in Manila. Okay, some of the projects that are being sold in the Asiana or the Manila Bay area is Monarch Park Suite. So I've heard that a lot of Singaporeans are buying here in this area because of the Manila Bay location. So you might want to take a look at this as well if you're interested in the Philippines. Okay, now to go into the other areas in the Philippines. So Cebu, if you've gone to the Philippines, you've probably visited Cebu. It's the second largest metropolitan area following Metro Manila. I love this place because it has a balance of urbanity as well as natural attractions. If you wanted to go to the beach, you only have to take, like a 20-minute taxi ride to go to the beaches in Mactan, close to where the Shangri-La is. So, the quality of life here is very attractive. Also, aside from the manufacturing base in Cebu, it's being propped up by an increasing BPO presence. So, the economy in Cebu is also booming. Okay, and one particular development that has been taking advantage of the growth is One Manchester Place. It's in the development by MegaWorld called Mactan New Town. So it's close to the Shangri-La. It's right beside the Shangri-La, and it features several residential condominiums, BPOs, office buildings, as well as hotels, and they will have resort close to right in front of the beach. So a lot of Japanese investors have come in, most of them retirees. This was actually marketed first to the Japanese retiree market, and they sold 3 buildings to the Japan market before they actually started to market it in the Philippines. So this is an interesting approach. So it's another hot spot. Some other hot spots that you might want to look into would be in Cebu Business Park. So Ayala Land also has some projects there. So, and also some other projects could be found in Mactan with a beachfront. Okay, another hotspot would be Boracay. So it's one of our popular attractions. So, it was recognized as one of the top beaches all over the world by Travel and Leisure. It's called the Best Island back in 2012. And then the top 10 best party destinations, as well as Lonely Planet's top 10 best beaches in Asia. So a lot of tourists come here, and now also there are some condominiums being sold on the other side of the island. This is another project by MegaWorld called Boracay New Coast. So they have a couple of projects that are called condotels or condo hotels. They're the Savoy and the Belmont. So if you want an investment wherein you could visit it, you could have like about 2 weeks. You could use the property for 2 weeks, and then it will be put back in the hotel pool where it will be rented out to those that are vacationing in Boracay. So if you don't really need to use an investment, a property in Boracay, then this would actually be a very good investment, since you could lease it out to those requiring hotel rooms in Boracay. So on average, it's about 6.3 million pesos, about 182,000 Singapore dollars. Okay, then just to summarize, these are the locations. So I mentioned Makati CBD, Century City is an emerging township outside of Makati. Rockwell Center, very popular with expats. Asiana City, which is along Manila Bay. So you have the Manila Bay views, and as well as the Casino District. So it's conveniently in the Casino District. And then you also have Mactan New Town in Cebu, and then in Boracay, you could look at Boracay New Coast. Okay, so I just wanted to be transparent and as honest as I could with regard to investments in the Philippines. So what should we look at if you decide to invest in the Philippines? So there's been a lot of talk of an asset bubble in the Philippines, particularly in Metro Manila, with the condo market having a boom over the past 6 or 7 years. So there has been that fear of a price bubble. We did take a look at that potential, and we found that on average for luxury properties, the average growth would be about 5.5%. So with that statistic, I'm not that worried. What I'm more worried now would be the amount of condos that will be introduced over the next 3 years. So actually the stock in the main CBDs will increase by 50% for the next 3 years. So that would be a cause of concern. So if I'm investing in Metro Manila, I would go for the top locations, so those that are found in Makati CBDs or in Fort Bonifacio or in Rockwell, just because of the location, the popularity, very low vacancy rates. It's always popular with the expats. Okay, also the taxes that are involved. So if you purchase a property, you'll be imposed with the documentary stamp, tax, transfer taxes. Also, might be hit with a value-added tax. If you're a seller, you'll be hit by capital gains tax, if you're a corporation, you have a value-added tax and some local business taxes. So that might range between 18 to 20%. So if you're actually planning to flip a property, it might not be a good thing to do in the short term. You might have to wait for about 5 years to be able to do that, just to be able to recover the impact of the taxes. Also, you have to be aware of the restrictions on foreign ownership. So for condominiums, each building ownership is limited to 40%. However, for foreigners are not allowed to own land. So you will have to take a strategy where you buy a condominiumized property. Also, some other notes that I'd like to highlight. Yeah, well, aside from the foreign property ownership restrictions, better strategy would be to buy a property that already is existing or it's been completed, rather than to buy off plan, because you will have to wait for about 3 or 4 years before it's completed, and then before you could rent it out. So if you already have the funds and you could invest, then I would rather go for a project that already has been completed, so I could rent it out right away and reap the benefits of the rental right away. And then finally, maybe in terms of risk, we are having our presidential elections in 2016. So you might want to wait a little bit just to take a look at what is the result, because we have had this road to being a more transparent country, or having a more transparent government that is combating corruption. For the present administration, we are hoping that in the future administration that all of these policies are pursued. So by 2015, I would think that a lot of investors would take a wait and see position. So these are things to watch out for. Then again, if you'd want to risk it, if you're looking for higher yields, and maybe take the plunge and take that risk. So that concludes my presentation, and maybe if you have questions later during the forum, entertain them. Thank you so much.